Good morning, all of you. All are welcome back to the session. In last sessions, we discussed about risk return characteristics of different types of investments, and we came to the portfolio level investments also. Then we discussed about the capital market line and the different characteristics of capital market line, where we deal with lending portfolios and leverage portfolios. So with that, we have grasped reasonable level of knowledge with regard to investment analysis. Now we need to understand how we can apply these things into the day-to-day affairs, where we do different types of investments or we take decisions with regard to our investments, and our ultimate objective is to get a value addition to our business, whatever the business we are engaged in. Either you might work in a bank or other financial institution. All these institutions, their main objective is to add value to their organization through the businesses they do. If you take in terms of a business, the financial business, where almost all the businesses they try to make investments, especially the financial business. Now these investments, they have to do in a particular manner where they can add value to the organization. So value addition is a little different with profit making. Profit making is a straightforward thing, but just profit making will not help, because even though you make profit, sometimes it is with so much of risk. So you have to have a risk return trade-off in order to have this value addition. So that is the important thing you need to understand. So therefore, the correct level of understanding will help you to go through that path, and that will really benefit your organization. So today we are trying to apply what we have learned, and I will go to another presentation where you have to just see how we can apply the things in normal day-to-day operations. So I will go to that presentation now. I think you can see that even though this particular thing introduces about portfolio theory, capital market theory, capital asset pricing model, all those things are included here, but I will just go into the things which we have already learned. Right. Now this is the expected returns, and we learned these things, we studied these things, and the symbolic expression is given here. Now it is the average return on a risky asset expected in the future. Either it is risky or not, it doesn't matter, but normally these probabilistic type of introductions are normally given on risky assets. So PI, the probability of each state of economy, I think you can remember now, which we have done already. So then RI is the expected return under each state. Then the risk premium, there's a thing called risk premium. Now this risk premium comes with the concept of risk-free rate. Now what do you mean by risk-free rate? Now, risk-free rate is the rate which we expect from a risk-free investment. What do you mean by a risk-free investment? In general understanding, what we can see is normally the government securities are taken as risk-free investments. Though we say it is risk-free, it is in terms of only the credit risk or default, because the government securities cannot be defaulted, since the government has the power to print money. Even though we consider these government securities as risk-free, in some occasions it cannot be considered as risk-free, because there's exposure to market risk even in government securities. If there's a change in interest rate in the markets, then the value of those instruments will come down. So that is the risk, and that we call the market risk. But this risk-free means, if you strictly speaking, the risk-free is it is free from credit risk. That is the notion. Right. Now just look at this concept, which we call the risk premium. Risk premium. Premium is the amount of the margin or whatever as against the risk-free rate. So in other words, if you have a return which is over the risk-free rate, then we can go for that investment. Otherwise, if you can invest in something without any risk and get a return, so that return is very much absolute. But if you go for a risky asset and the return is lower than that risk-free rate, or you should not go for that. So that is why if you go for risky assets, you need to have a reasonable premium. Reasonable premium. So that reasonable premium, the quantification of that reasonable premium depends on the additional risk you have taken, or you have really taken up. So then in this slide, the main concept here is the risk premium. Risk premium. Now, for example, say I will just say the government securities, the return on government securities is 6%, say in Sri Lankan condition, 6%. And there's another security, it really gives a return of 10%, say. Then what is the risk premium? 10% minus 6%. 4% is the risk premium. So that is how we can go for risk premium. Right. Then we just studied about the standard deviation, and standard deviation we calculated when the expected returns are taken into consideration. Now it is now this is the way that standard deviation was calculated. Now you just see we did a expected return calculation at the beginning, and that expected return is deducted from each return, and we get the square of that, and it is been multiplied with each probability, and that will give you the sigma squared or variance. But the standard deviation is the square root of variance. Now you can just see the example. Stock A gives average return 4% on the normal situation. During the crisis, stock A plumped and generated negative return -2. However, stock A expected to generate return 10% on bullish economy. Given the possibility of crisis, normal and bullish to be 30, 50 and 20 respectively, what is the expected return and standard deviation of stock A? Now, this is a typical question you might have to face with. Stock A gives average return 4% on the normal situation. During the crisis, stock A plumped and generated negative return. Now you can just look at the question and see how this question has given the data. Stock A gives average return. Now that is average return of 4% on the normal situation. Now the situation is here taken as normal. When the normal situation is there, the stock A gives a return of 4%. Normal situation 4%. Then stock A plumped and generated negative return -2%. Right. Stock A expected to generate return 10% on bullish economy. Now you know what is bullish economy. Bullish economy is, I think everything is booming like, and prices are going up like, the stock prices are going up. In such a situation, we call it a bullish market or bullish economy. And given the possibility of crisis, normal and bullish, now the possibilities are also given here. Given the possibility of crisis, normal and bullish. Now you can just equate this crisis situation as the plummeted now plumbed and generate negative return. Or that negative return is really connected to the crisis. So therefore, you can get the possibilities. Crisis, there's a possibility of 30% in crisis. There's a possibility of 50% in normal, and bullish is the it is 20%. Bullish economies probability is having a bullish economy, the probability is 20%. So those things we have taken into consideration, and this particular expected return is calculated on the basis of that. Now you just look at it. Rather than going into the blackboard, we can just look at it and get the real answer. So 30% is the probability for a crisis situation, and at that time the return is -2. So that is why 0.3 multiplied with -2% plus 0.5 is the normal situation. That is multiplied with the respective return. The respective return for a normal situation is 4%. That is why we multiply it with 4%. Then you go to the bullish situation. The bullish situation is with the possibility of 20%. So that is 0.2 into 10%. 10% is the return generated under a bullish economy. So that is 10%. Now when you do the calculations, you will end up with this particular answer. That is, expected return of a stock A is 3.4%. This is the expected return. Now then we need to go to the calculate the total risk of stock A, or the standard deviation. So that has to be calculated in this manner, because we have already calculated the expected return, and that return we have to deduct from each returns. Now when the crisis situation, the return is -2, and we have to deduct 3.4 from that, and that has to be squared. And next time is next economic situation is the normal situation. There the return is 4, and you have to deduct 3.4 from that, and it has to be squared. And you have another situation, it is the bullish situation. There you get a return of 10%, and you deduct 3.4 from that also, and it is to be squared, and you multiply that with all these things. And now here you can see another denotion here. Point, you can see 0.5 is given here, that is the power. 0.5 power is half, to the power half, like. So that is the square root of this. So that is how this is symbolized here. So these things you have to be familiar with. So this is calculated and the square root is taken, and after the square root is taken, the answer is 4.2%. So what I want to do is, now you just get the answer for the, now you can solve this and get the answer for this. Or in other words, if you get the square of this, you will get this, the variance. But here the need is not to get the variance. We have gone through the process of calculating the standard deviation. This is what we have already learned, right? And there's another example given here. Now that's example also on the same lines. So you can see how you can calculate the expected return with this work sheet or whatever. Then the standard deviation is calculated on the same manner here. Right. Now you can just look at this slide. Now these things are actually, we have already gone through, but you can have a clear knowledge on these things. Portfolio, a group of assets such as stocks and bonds held by an investor. Group of assets. So that means a portfolio means more than one asset. Now if you want to have a very simple portfolio, at least it should have two assets. Two asset portfolio is the simplest portfolio. Now then we go to the other concept, that is efficient portfolio. Portfolio that maximize the expected return given a level of risk. For a given risk, if a portfolio can have the maximum return, so such portfolios are called efficient portfolios. Then optimal portfolio is the most preferred efficient portfolio that an investor selects. So that depends on the investor's requirement. So that is why how the optimal comes. Now you can have different efficient portfolios in that category. So can you remember that we did a particular curve? That curve so we plotted points by looking at the expected return and risk. So with that, risk in the horizontal axis and expected return in the vertical axis, we did a plot. And on that plot, we had a frontier line. So that frontier is called the efficient frontier. So I will show that again here, because it is, I think you can just have an idea like this, because I think some of the people have not got it very much correctly. So therefore, I think I will just do it this way. I will go to the, I will explain it on the board. Now this is the way we did it. Now along the horizontal axis, we just symbolize risk. Then we have expected return along the vertical axis. Now the portfolios can be represented through their expected returns and risk, because those values we have already obtained. for different portfolios. For example, you can say a portfolio 1 has a risk of so much, return of so much. So since the coordinates to be given as xy, the risk has to be given first. So then such type of points we can plot on this graph. If you plot that way, you will get different points like this. Different point like this. Right? Now you can just see these points. You can have a particular set of points where you can identify those points as the boundary, and that is the upper boundary we call it, and that is also called a frontier. Now in this case, this is a frontier. This is a frontier, and we call it the efficient frontier. And if any portfolio is taken on this particular curve, and we call such portfolio an efficient portfolio. An efficient portfolio. That is how these efficient portfolios are defined. A portfolio which can be plotted on the efficient frontier is called an efficient portfolio. I think you can get that particular concept into your mind. So that is very important. And at the same time, now you can just see, if you take this particular portfolio, now we can say it is say portfolio A, this is portfolio B. If you take portfolio A, now this is the amount of risk. Or we can put it as sigma A. Sigma A. It is the risk of this portfolio. So what is this? It is the return of this portfolio. We can say RA. Sigma A, RA. Right? And if you take this, the other portfolio, now what is the return of this portfolio? RB. RB. What is the risk of this portfolio? Sigma B. Sigma B. If you take another portfolio here, that is also on the efficient frontier, we can denote it as C. Then its return we can say RC, and the risk is sigma C. All those are efficient frontiers. All those are efficient frontiers. Sorry, all those are efficient portfolios. So portfolio A is an efficient portfolio. Portfolio B is also efficient portfolio. Portfolio C is also an efficient portfolio. But there's another concept called optimum portfolio. Optimum portfolio. How are you going to select that? That depends on the investor's requirement. Now the investor wants to have a particular risk and with a particular return. So that is the selection of the investor. So investors, for the investor's point of view, he or she will choose one from this. And that is what you call the optimum portfolio. Now, you know, there are, in organizations, the top level management or the board of directors, they have a risk attitude. They have a risk attitude. And the organization, according to the organization's capital base or the net worth the organization has, the risk appetite can be decided, or risk capacity. In other words, risk appetite is the amount of risk the organization want to bear, like to bear. So that is what you call the risk appetite. And not only that, the top level management, the board of directors, they have a risk attitude also. Now, what do you mean by attitude? Now, some people are risk seeking and they want to have high return, even with the risk. So they like to take a higher risk in order to have a higher return. That is their nature and that is their attitude. That you can't change. And another set of directors would be sometimes risk averse. Risk averse means they want to take risk, but they want to take the minimum risk. So say you have two investments and one investment gives a return of something with a lower risk. So that particular return on that particular investment only they select. Such investors are called risk averse investors. The other side, they are called speculative or risk seeking investors. Now, speculation is very much at a higher level, and they are not only risk seeking, they are really, haphazard. So I don't put these risk seekers into the level of speculators, but risk seekers are really, they want to have risk. They like to have risk. So according to their risk attitude, the optimum portfolio has to be selected. I think you get my concept understood. So that all depends. The optimum portfolio depends on the investor's risk attitude. Right. Now, again, I want to show you something else also. Now, you can see different types of points here. Now, all these points represent portfolios. Number of portfolios are represented here. Now, all of these points represent portfolios. So, if you take any portfolio just below this particular point, and all these portfolios gives a return, now we had a issue with the network. Now it's okay. Sorry for the inconvenience. Anyway, we have been discussing about the efficient frontiers and optimum frontiers, optimum portfolio, sorry. Now, as per the discussion, we identified, if you identify a particular point where that point representing a portfolio. Now, here point A represents a portfolio which is on the efficient frontier. B also represents a portfolio which is on the efficient frontier. C also another portfolio represented, and it is also on the efficient frontier. So all these portfolios are called efficient portfolios. Efficient portfolios, right? All those portfolios are called efficient portfolios. Now our question is, what is the portfolio we can identify as optimum portfolio? As I told you earlier, that depends on the attitude of the investor. That depends on the attitude of the investor. What do you mean by attitude? Now, we call it the risk attitude. Some investors are risk averse. Risk averse. Risk averse means they want to have a return with minimum risk. We are not going to tell them that they are not going to have the zero risk, but if they want to have a return, they have that return with the minimum risk, right? So other parties or other category, the other category is the risk seeking. They always want to have risky business because their motivation is to have high profits. So that is the other category of risk attitudes. So depending on that attitude, their selection is different. Their selection is different. So now if they select a particular portfolio for their necessities or for their requirements, we call that portfolio the optimum portfolio for them. Right? I think now you got the matter clear. And there's another thing I want to tell you. Now there are so many other points representing portfolios on this graph. But if you take any point which is just right below that, and any of these points we can say is less than the return of the portfolio A, but it is with the same risk. So therefore, all these things are not efficient because you can have a higher return portfolio with the same risk on the efficient front. If you take any point representing a portfolio down the line or just below this, no portfolio is generating a return which is equal to this. Always it is less than this return. Right. So such portfolios are inefficient portfolios. Right. Okay. Now we will again go to the presentation. Now you can just look at this particular wordings. That wordings really clearly shows that the most preferred efficient portfolio that an investor selects. It's a selection of the investor. Most preferred. Now preferred in the sense that is the preference is given by him. No. So therefore it is depending on the investor selection. How the optimal portfolio is selected. Right. Then who is a risk-averse investor with the same expected return but two different risks? He will prefer the lower risk. Such investors are called risk-averse investors. Then there's a thing called portfolio weights, percentage of a portfolio's total value invested in a particular asset. For example, say you have two assets in a portfolio, and one asset, the value of one asset is say 60. The other asset is 140. So then if you take the weights of these two assets, one asset's weight in the portfolio is 60 out of 200. 60 or 200. Other assets weight is 140 over 200. So if you put it as a percentage, it is 30% and 70%. So it's so simple. And portfolio expected returns is the weighted average combination of the expected returns of the assets in the portfolio. So that we have already done. Variance is also we discussed. But here I want to just show you these things because in another perspective we have discussed it here. Portfolio variance is the combination of the weighted average of the individual securities variance and securities covariance factor. Now covariance factor is also being taken into consideration here. Now it is given in symbols here. Now this is again explained here, covariance and all. All these things we have discussed. And the correlation coefficients relationship between the covariance and the correlationship. And these examples are also given here. Now you just see the same which I have already explained on the board. It is given here also. So they put it as 1, 2, 3, 4. Now here it says feasible and efficient sets of portfolios for stock C and D. Now C and D, we mix the, or we create a portfolio with different weights of C and D. Here, this is the weight is 100% here. Here, 0. Sorry, yeah, 0. That means you have, I mean, all of it is only one asset then. Then if you begin with this, the second one. Now the first one is only one asset, so we don't need to really think about it. But if you go to the second number 2, there you have C of 0.75, D with 0.25. The meaning is the C's weight is 75%, D's weight is 25%. And they are the respective expected return and the standard deviations given. Right? So that's the same thing what I have already explained. Now you can see the third one. Third one is really C has a weight of 50% and D also has a weight of 50%. There the expected return is 17.5 and standard deviation is 6.8. Number 4, there you have 0.25 or 25% of C and 75% of D. There the expected return is 21.2% and 17.4% the standard deviation. In the fifth one, you have the whole thing, that is D. If you have D as the whole portfolio, so it is not a portfolio in that case, it is individual asset, right? So number 5 and number 1 both are individual assets, not portfolios really. So 5 is the assets D. There you have an expected return of 25 and standard deviation of 60%. So it's a high standard deviation. Now you can see. Now these are plotted here. Now number 1 is this. Number 1 is this, and it is plotted. Right. Now you can just look at it and see how it has been plotted. Now number 1. Now what is ER? That is the X coordinate. It is 10%. Sorry, ER is not the X coordinate, Y, that is Y coordinate. Anyway, X coordinate is 30 here, but they have given it in the other direction. Anyway, now this has to be given first, right? 30%. So 30 comes here, and the other corresponding one is 10, 30 and 10. No? So that is how the point number 1 is plotted. Point number 2, there you have 3.9 of standard deviation, 3.9. So somewhere here. Now 3.9 comes close here. Now this is 10 now. Here, somewhere here you get 5%. Now 3.9 is little below 5%. So that is how this number 2 is plotted. If you take number 3, SD is 6.8. So 6.8 is somewhere here. It is yeah, more than 5. No, 6.8 is more, close to 7. No, so you can just see it is less than 10, but it comes here 3. And the return would be 13.8. So 13.8. So number 3, not 13.8. It is 17.5. 17.5, right? You get it this way. And number 4. Number 4 is SD 17.5, 17.4. So it is somewhere here. Somewhere here. You can see 17.4. And the return is, expected return is 21.2. So 21.2 is just about 20 here, right? Now you just look at it. So all the points are now being plotted. If you take the number 5, the point number 5, that is point number 5, you can see expected return is 25 and standard deviation is 60. You see 60 here and 25 is the return. Yeah, it is in the middle of this. That is how the point number 5 is plotted. Now when you just connect all the points, you will get a curve like this. This is the curve you can get. Now we are referring to another type of a concept. Now you can just look at this particular curve. Now you get 1 is not included in Markovis efficient set because it was dominated by 2, 3 and 4. Now this particular one, because you can't get it because the reason is now it doesn't it doesn't give a return which is higher than this. So therefore, this particular point cannot be taken as line in the Markovis portfolio. Now this is, I want to just tell that, and this portfolio theory is also known as Markovis theory, and Markovis is the person who invented these things, Alfred Markovis. So this dotted line of the dotted red line, it really signifies the non-efficient type of a portfolio. So you can see why it is non-efficient, because it is below this set of points. That is why we put it as inefficient, because it doesn't come into this particular frontier. That is the reason. Space on the left side of 2, 3, 4 and 5 are not attainable from combinations of C and D. Space on the right side of 2, 3 and 4 are not included in Markovis efficient set. Because there's another point given here. 6 has same return as 2, but 6 gives higher risk. In another word, 6 has same risk as 4, but 6 gives lower return. So that is what I told earlier. Now you take 6 here, number 6, the portfolio given as number 6. So that portfolio's return. Now say, if you take 4, 4 has a higher return than 6, but it is with the same risk. And another one, 3, that also has a higher return than 6 and with the lower risk. So therefore, 6 cannot be taken as a efficient one. Right, the next diagram also signifies the same thing. And minimum variance, they took, I think that is a good point to note. You can just look at this curve and the variance or the standard deviation is plotted along the x-axis. So x-axis represents the standard deviation, y-axis represents the expected return. Now with that you get this curve. If you take this point, it is the overall minimum variance or minimum standard deviation here. That I think you understand that. Now the correlation coefficient also been discussed here. Now another concept given here.
So excuse me.
Yeah.
In the slide number 15, if you can go again.
Early on.
Yeah.
Yeah.
The total curve is not the
this one.
Yeah.
Is this the one?
Yeah.
Right. No, this is a different one in the sense this is being taken in a different situation, not that C and D, right? This is a overall one, something else, right? But this is the way it can come if you take any two assets in a portfolio and we have different mixes with these two assets, or even some other portfolios. If you have global level portfolios into consideration and you plot the points like this, and you will have this type of a curve. So you can just see individual assets are also being plotted here. Individual assets means these are not portfolios, but these are portfolios. But what happens is, if you do a thing like this, taking different portfolios from different institutions, or even if you do that, you will ultimately get a frontier like this. That is what happens. So that is what it says here. So therefore, what I want to tell you is, in that one, that is why we call it global minimum variance portfolio. Global minimum can. So what we have to say is, we have taken all together here. I mean, a universe of portfolios we have taken, and on that you have a particular portfolio representing here, and that gives the minimum variance. It is understood, no? Now you can see, if you take another point here, now I put the arrow mark here. If you take another point here, that point's variance or the standard deviation. Now here they have used the word variance, minimum variance, but that's okay, because if you have a minimum standard deviation, minimum variance is also possible, no? So then there's no big difference here. Now if you take a point here, I think you understand that the standard deviation of this portfolio is less than the standard deviation of this portfolio, is it? That is why we call this the minimum standard deviation portfolio or minimum variance portfolio. That is the concept that this particular diagram wants to represent, right? You understand that? Because this is not the signification of or the representation of earlier one. The earlier one is we have taken here, we have taken specific two assets, but here it is not. Here it is the global level portfolios taken. Now you understand?
Yes, sir.
Then we go into another very important point to note, and we call it portfolio diversification. Now what is that? Now any portfolio, so you can start with one asset, but one asset is, we don't call it a portfolio, but when another asset is added, we call it a portfolio. Then again we can have another asset, then it will be 3. Likewise, we can add one by one to the portfolio. Now you can just look at this this diagram. You can see the x-axis. There you have 0 assets here, 10 assets here, 20 assets here, likewise, number of stocks, 30 assets here, 40 assets here, 50 assets here, 60 here, and all that, up to 100. There are different types of stocks. So now what happens here? When you have only one asset, what will happen? It is very high standard deviation, you can see. But when you have say 1 or 2 assets, it comes little down, and up to say when it is 10, when you have 10 stocks in the portfolio, the standard deviation has come down to this level. So it is around 25 or something like that. If you do further, then your standard deviation gradually coming down, and it comes down to a certain extent, but further it may not be reduced after a certain point of assets. Now just look at it and see what is the point where the curve is becoming parallel to the x-axis, the starting point. Can you look at that? Now I am just asking you, I want to put it this way. Now you just look at this. Now I am just asking you a question, right? this is only as per the appearance, right? Can you see at what point the curve becomes parallel to the x-axis? I'm just asking you.
20.
Yeah? Yes,
20.
yes. 80.
20.
80 or 20?
20.
20, you say 20. I mean, seriously, you look at it now, you can see now when I say parallel, now say, here you can see the curvature now. Now, can you say this is parallel to x at this point? Not parallel, no, not yet.
75.
About, yeah, it's 75, yes, maybe somewhere here. In my opinion, I don't know. You all, I think your eyesight is better than my eyesight, so therefore, just your answer, I will accept your answer. So I think in my opinion, it can be somewhere here, just above 80, like 80. Do you agree with me? Because otherwise, now if you go this way, it is not parallel, no? Okay, what do you say? Is it okay to take 80? You can give your opinion. Now we can do one thing if you want. If you draw a line from 20, right? And 20 here in the annual standard deviation, and there you draw a line from 20 and see how that line, now you can have a straight parallel line from 20, and it might touch us somewhere here. So 75 or 80 would be okay. I think 75 may be better position. So there's no hard and fast rule to say anything here, but on the face of it, what you can say is it is around 75 or 80, no? I think you agree with me on that. Yes. Anyway, if that is the case, the meaning is if you further add assets or the stocks after 75, there won't be any difference. Same risk is prevailing. So that means there's a risk we cannot reduce further by adding more assets to the portfolio. But now from here you can see, if you add one by one, till 75 you can add assets. When you add, as and when you add assets, your total risk coming down. But after a certain point, when you add another assets, your risk, the total risk may not come down. So we can just look at it and see it's around, say, something 75 or somewhere. After 75, it would not be reduced further. So that means there's a particular risk which we cannot reduce by adding assets. Now, this adding assets means it's a action where we do for portfolios. We call it diversification. So we add different assets to the portfolio. So that is what you call diversification. Now, if you do diversification and reduce risk, that can be done up to a certain level only. There's a limitation for that. You can't further diversify your, after diversification, you will not be in a position to further reduce the risk. So that point we have to take. From that point onwards, even though you add assets, the total risk will not come down. So that risk is called the particular name. We call it non-diversifiable risk. Non-diversifiable risk. Right? So the other side, now if you come to that level, so that risk is called the non-diversifiable risk. But the other parts, before coming to that, you have another risk which is higher than that. So that amount, which can be added is called the diversifiable risk. Diversifiable risk. So then if you take any type of a risk, that risk contains the diversifiable part and non-diversifiable part. Or in other words, the risk can be divided into two, a particular risk, total risk. Out of that, a set or one part can be diversified. The other part cannot be diversified. The diversifiable risk and undiversifiable risk. Diversifiable risk is called non-systematic risk. Undiversifiable risk is called systematic risk. So that is what we have learned now. Right, now that it is really given, it mentions here diversification. Spreading an investment across a number of assets will eliminate some but not all of the risk. That is what you call diversification. Now, if an investor invests in one asset, he has to deal with that asset, and that asset's risk he has to take. He has to really accept. But when he add another asset, then there will be the diversification effect, and the total risk would come down to a certain extent. And that is why this particular diagram shows when you add assets to the portfolio, your total risk coming gradually down. Now it comes to a certain extent or certain level, and thereafter, even though you add assets, it won't come down. So that is what it means. Now, the returns distribution is also given here, stock A, stock B, and portfolio AB. They are the stocks are positively correlated. Perfectly positively correlated means it is the correlation coefficient is 1 or 100%. If those two assets behave like this, now you can see stock A and stock B behaves this way, and portfolio AB also behaves in the same manner. If negatively correlated, what happens? Here you can see rho is -1. That means negatively correlated. Now, when negatively correlated assets are being given to a portfolio, the portfolio will really become, the risk will be reduced to a very low extent if the two assets are negatively correlated, perfectly correlated. Now, in this, there's another thing. Anyway, now we will go to the lesson again, rather than going into this presentation. Now, what I want to tell you is, now we have gone through this diversification process and found something. So that's a very important concept you have to understand. Since this has a big role to play in our future studies. Right. Now, anything you need to clarify on these things? Anything? Now we have done a certain we have done certain discussions now, and we try to understand different concepts. You have any issues on these concepts and any confusions or whatever, any clarifications? If you have any clarifications, let me know. Now, the efficient frontier thing, you understood. Yes. Okay. We will now go to the presentation. The lesson we did last time. And we talked on portfolio theory. Last time we went through this and we got some understanding about capital market theory also at last. This we have done. Right. Anyway, we couldn't really follow all these things last time. Now this particular concept we have already discussed now. Now you can just see, now just follow this. The curvature of the efficient frontier depends upon the correlation of the assets returns. The efficient frontier curve is convex toward the ER axis because all assets have correlation coefficient that are less than +1 and greater than -1. Then this gives a description about optimum portfolio. Under the Markovis portfolio theory, following assumptions are taken into consideration. The investor seeks to maximize the expected utility of total wealth. All investors have the same expected single period investment horizon. So what investment horizon is the particular time period he likes to keep the things in the portfolio. Investors are risk averse. Investors base their investment decisions on the expected return and standard deviation of returns from a possible investment. Perfect markets are assumed. Now these assumptions are very important. Now in examinations, sometimes this is being tested, and you have to put forward the assumptions of this Markovis portfolio theory. But I think these points are not very difficult or not very confusing because those are generally accepted things. Now, for example, now when you say investors are risk averse, now you know what do you mean by risk averse? Risk averse means they like to have the return with the minimum risk. That is what you mean by risk averse. And the other assumption is all investors have the same expected single period investment horizon. Now, that is another assumption, but now depending on the requirements and their choice, the investment horizon may be different with each other, with each investor. Whereas in this Markovis theory, we assume that all investors will have a same investment horizon. Now, I don't know whether you understand this concept called investment horizon. The investment horizon is a particular time period where you make your investment and you wait for a return. The particular person can wait for some time to get a return. So such is called the investment horizon. So normally the investment horizon is about 1 or 2 years for most of the people. They do very much medium term or short term investments. Now, for example, say for a trader or whatever, trading investment or doing that type of thing, their investment horizon is very, very, very short. 1 month, 2 months or 3 months or whatever. So that also can happen. But for an organization of say a pension fund or whatever it is, their investment horizons are very, very, very long. Likewise, the investment horizon depends on the investor's perspectives or investment choices. Investors' choices. And they always base their decisions on expected return and standard deviation from a possible investment. So that's another assumption we make. And we always assume perfect markets. Now, again, what I have already discussed, it is given here. Given the above assumptions, an investor will want to hold a portfolio somewhere along the efficient frontier. The exact location depends on the investor's risk-return preferences. Depending on the risk averseness, investor needs higher compensation for assuming risk. Then the selection will be optimal when it is made wherever on the frontier itself. Now, another assumption under capital market theory. Now, number one, investors are capable to attain the investments on efficient frontier. So, if now you know what is efficient frontier, and investors are always in a position to get these investments. Money can be borrowed and lent at the risk-free interest rate. But it never happens in the normal market. You can't borrow at interest rate, risk-free rates. So that is not a possibility. But anyway, we assume in that manner under the capital market theory. Borrowed and lent at the same risk-free rate. And you all know in the market, it never happens borrowing and lending at the same rate. You can't do that. But in capital market theory, we assume that. And at the same time, variance of R return is 0. Investors have homogeneous expectations. So what do you mean by that? Homogeneous expectations, idealized uncertainty. So they think, that is what you mean by expectations, they think that all have been under control. That is what it means. Investments are infinitely divisible. So you can have very, very small parts of it. That's what it means. No taxes or transaction cost. No inflation exists. Capital markets are in equilibrium. You know what is market equilibrium? That's an economic principle where market equilibrium is you have supply and demand in a particular price determination symptom, yeah. Supply and demand, and you have an equilibrium price. So that equilibrium price is when always the capital markets are in equilibrium means capital markets have equilibrium prices, and that is why we call the borrowing and lending can be done at the same rate. when we introduce a risk-free asset into the above mentioned portfolios with the said assumptions, the efficient frontier is changed from a curve to now this thing we did last time also. And there what we did was we add a government security into the portfolio. The government security in the sense now that is a risk-free asset. So with the introduction or with the inclusion of that risk-free asset into the portfolio, the efficient frontier has become a straight line. That's what happened, and we discussed about it last time. I want to again do it because some of you might have not been able to grasp those things at the first instance. And this efficient frontier is called the capital market line. Now, of course, now this capital market line or the efficient frontier of portfolios with risk-free assets is being generated by adding risk-free assets to the risky asset portfolio. Now, which is called the capital market line. And this capital market line become a tangent to the efficient frontier, and it is become tangent to the efficient frontier on a particular place, and that particular portfolio is known as the market portfolio. And to the left of this curve we call it lending portfolio, to the right of the curve we call it leverage portfolio. So the lending and leverage portfolios are really it is explained in a particular manner. Lending portfolios are explained in one way, and leverage portfolios are explained in another way. So it's like this. Now you can have risk-free portfolios, and now you can see the yes, the expected return on a CML portfolio composed of R and M. Now CML portfolio means now it contains risky assets and risk-free assets. That is what it means. So from risky assets you are having expected return of ERM. From risk-free assets you are having a return of R, because it's a combination of risk-free assets and risky assets, right? So now such portfolios are known as capital market line portfolios. So that portfolio generates a return. So that return, how are we going to calculate? Now you can remember that when we calculated the portfolio return, what we did was we got each asset return and multiply each asset weight with that return and get the total. Or in other words, it is the weighted average return of both assets. We got the portfolio return. In the same manner, we can calculate the portfolio return in this way, because the portfolio return of risky assets would be ERM. Return of risk-free asset is capital R. You have weight or portion of XR in the portfolio of risk-free assets. You have a portion of XM of risky assets in your portfolio. Therefore, the expected return for the portfolio is given by XR into R plus XM into ERM. How it is given here. where the weights of R and M are considered as XR and XM respectively. So the XR plus XM would be 1, and XM is equal to 1 minus XR. Therefore, ERP is equal to, so we can really get rid of XM and just say XR plus XR into R plus 1 minus XR into ERM. XR is the proportion of an investor's wealth invested in R, and ERM is the expected return on the market portfolio. The risk of a portfolio composed of R and M is measured with the following quadratic equation. Now, I will explain it on the board. Now, you can just look at it. Now, you have two assets. Sorry, two sets of assets. Now, one set of assets are risk-free, other set of assets are risky. Now, the portfolio of risk-free assets will have a return of R. Portfolio of risky assets will have a return of ERM. And we will assume the risk or standard deviation of risk-free assets as sigma R. Standard deviation of risky assets as sigma M. Right? And with that, we apply it to the equation to calculate the portfolio risk. Now you can just look at it. Sigma P squared is equal to XR squared sigma R squared plus 1 minus XR. So why we put 1 minus XR? Because it is XM. XM equal to 1 minus XR. 1 minus XR squared into sigma M squared plus 2XR. 1 minus XR rho sigma R sigma M RM. No, sorry. Rho RM sigma R sigma M. Anyway, since it is, you can, I don't know whether it has some confusion here. Therefore, I will explain it on the board with the same symbolization. Right. I will go into the explanation of capital market line portfolios, return and risk. Now, when you say CML portfolios, the meaning is, when you say CML portfolio, capital market line portfolios, what is the meaning? The portfolio contains a set of risk-free assets and another set of risky assets. Set of risk-free assets and another set of risky assets. Right. So that is the meaning of a portfolio on the CML. A portfolio on the CML. Right. Now I will assume the portfolio on the CML has XR of risk-free asset weight. So we can say the portfolio has a risk-free asset weight XR. XR. Risk-free asset weight XR. And the same thing has a risky asset weight XM. XM. Then we can say risk-free return. R. Risk-free return is R. Risky asset return. How much? We call it RM or ERM. ERM. So that is expected return. Now you can remember now we did so much of calculations on expected return of risky assets. In the same manner, we can get this ERM, expected return of market portfolio or the risky asset portfolio. So that is the risky asset return. And here, when you say weight, risk-free asset weight is XR and risky asset weight is XM, the meaning is XR plus XM is equal to 1. It's like this, no? When you have two assets, one asset you have a weight of 30%, the other asset 70%. 30 plus 70, 100. That is 1. Or 40%, 60%, then 100. Always it comes like that. That is why we put XR plus XM is equal to 1. XR plus XM is equal to 1. And from that we can get XR is equal to 1 minus XM. I think it is understood because you have this equation. If you remove this XM from this side, you have to deduct XM from this side. Then XR is equal to 1 minus XM. Right? Okay. Now I will calculate the return of the capital market line portfolio. Return of the capital market line portfolio. So we can put it this way. R equals R into XR plus ERM into XM and R into XR plus ERM into XM can be replaced we can put it this other way because we can put it in R terms. Yes. I will just look at it and see. No, you can put it this way. XM equals 1 minus XR. So you can say you can replace XM by 1 minus XR. . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . . This is R. Then this is the return of the capital market line portfolio. Now, in order to get the risk of the capital market portfolio, we can apply the portfolio risk formula. We have just studied the formula to calculate the portfolio risk. Sigma p squared is equal to W1 squared, sigma 1 squared, so and so forth, W2 squared, sigma 2 squared, 2 W1, W2, covariance 1, 2. So that is the formula we are going to apply here. In order to do that, we have to assume certain things. So then you can say now our next calculation. Shall I do it here? It's okay. Yes. Calculation of CML portfolio risk. Calculation of CML portfolio risk. So for that, we need to have these assumptions. Risk of R. You have to put it as sigma R. Risk of risky assets. Sigma M. Then you can say covariance, rho RM with the correlation of R and M. The weights we already know weights. What are the weights? XR and 1 minus XR. These are the weights. XR and 1 minus XR. Now we have to apply these values to the formula. The formula I will write here. Sigma p squared is equal to W1 squared, sigma 1 squared. So W1 is XR. XR squared, sigma R squared plus XM squared, not XM, we took 1 minus XR as the XM. 1 minus XR squared sigma M squared plus 2 W1 is XR, W2 is 1 minus XR. Then sigma R, sigma M, rho Rn. So this is sigma p squared. So in order to get the sigma p, we have to get the square root of this. Square root. So we can say sigma p is equal to the square root of this. Now, if you take the it is again, you can say sigma p is equal to sigma v squared is equal to xr squared sigma r squared. Now we are referring to sigma r. What is sigma r here? Sigma r is the risk-free asset. What is the risk of risk-free asset? It is 0. Risk-free asset risk is 0. So therefore, you can just apply 0 here. So when you apply 0 here, what will happen? This value will become 0. Then again, here also in this multiplication, you have sigma r. There also this whole thing will become 0. Then you will end up with what? You won't get this term here because sigma r is here, sigma r is 0. Since sigma r is 0, this particular whole thing will become 0. And again here, sigma r is in this multiplication, so sigma r is here because sigma r is 0, this particular term is also will not come. It becomes 0. Then you will end up with sigma p is equal to square root of 1 minus xr squared sigma m squared. That's all. Sigma p is equal to this. So in other words, we can say sigma p is equal to 1 minus xr into sigma m. 1 minus xr into sigma m. So I think that calculation is, even though this is available on your note, I just want you to show you the particular way it can be done here. Otherwise, you might not get it correctly, so that I just wanted to put on the board. Is that okay? Now this is been done on the board, and you will end up with this. Sigma p is equal to 1 minus xr sigma m, or 1 minus xr is xm sigma m. Sigma p is equal to xm sigma m. So the meaning is your sigma p is decided through the weight of market portfolio. Right. Now we will go to the example. Suppose you are interested in investing 60% of your wealth in the market portfolio and 40% in the risk-free asset. Can you see the screen? Can you see the screen?
Yes, sir.
Right. Now, as per this example, suppose you are interested in investing 60% of your wealth in the market portfolio and 40% in the risk-free asset. What is the expected risk and return of the 60-40 lending portfolio? Assume the market portfolio has an expected return of 15% and a standard deviation of 25%. The risk-free rate is 10%. Now, it is being solved here. Then just to do that, it's a very simple thing. You have 60% in the market and 40% in the risk-free asset. So therefore, 0.4 is the 40% into 10. 10% is the risk-free rate, and 15% is the market rate. 0.6 into 15, I will come up with 13%. And you have to get the, standard deviation of the portfolio also. Now that is given by 1 minus XR into sigma M or XM into sigma M. XM is the weight of market portfolio, that is 0.6 into 25% is sigma M. So then it is 15%. Now, therefore, the expected return and the standard deviation of return of 60/40 the Indian portfolio could be calculated as 13 and 15 respectively. Now you can see the next one. Next example is a little peculiar one because there you can see rather than investing, the person has done borrowing also. Now I think last time also we discussed about this. Borrowing can be taken as minus investment. Minus investment. So in that way, we will be in a position to balance the weights. Now see, as per that, I think we did it last time. I want to just give it again. And investor has a market portfolio with a standard deviation of return of 20%. Its expected return is 14%. Yeah. So that means the market or the risky assets will give a return of 14% and standard deviation of 20% is there. Available risk-free assets return is 9%. If the investor wants to invest in 150% of market portfolio. So how can it be done? In order to, invest 150% in the market portfolio, that means he has to borrow 50% from risk-free asset, making it a leverage portfolio. What will be the expected risk and return? Now, since the borrowing is a negative investment, the weight of risk-free asset in the portfolio could be considered as minus 50%, fulfilling the addition of the two weights equal to 100%. I think you now got the point because now the weight cannot be 150% altogether. So in order to have a balanced portfolio, the weight has to be 100%. So 150, you have to add minus 50 to 150 only to come into 100%. So the meaning is you borrowed risk-free asset 50%. That is what it means. Now, risky asset 1.5 years. 1.5 is risky asset. 1.5 into 15%, that is the risk-free asset return. And risky asset, the weight is minus 0.5 and return is 10. So you will end up with 17.5. That is the expected return of the portfolio. So risk of the portfolio will become sigma P is equal to 1 minus XR into sigma M. 1 minus XR is 1.5. Yeah. Now you know how it can becomes 1.5. 1 minus XR. XR is minus 0.5. 1 minus minus 0.5 is 1.5. That will become 37.5. It seems that even though the leverage portfolio generates a higher return, it is exposed to a high risk of 37.5. So you can just look at it that way. Okay. Now we did a problem like that. Okay. Now I will just give another example or another exercise, like, because rather than before going into the next lesson, because the thing is now, if you are not very familiar with these concepts in these particular lessons, it is difficult for you to get the understanding of the incoming lessons. That is why I want to just give you a better understanding of these basic things at the beginning. Now, there's a small exercise to be done. An investor has a portfolio with 125% of risky assets with a return of 20 and risk-free assets with a return of 9%. If the risk assets portfolio's standard deviation is 30%, what is the portfolio return? What is the portfolio risk? So do that. I will again go through it and I will just read it. An investor has a portfolio with 125% of risky assets with the return of 20 and risk-free assets with the return of 9%. So the risky asset will have a return of 20% and risk-free assets will have a return of 9%. And the weight of risky assets should be 125%. And the risk assets portfolio's standard deviation is 30%. Risky assets will have a standard deviation of 30%. So what you need to do is you need to first calculate the portfolio with risky and risk-free assets return to be calculated. Not only that, you have to calculate the sigma also, or standard deviation also in the portfolio. Try to do it. Yes, I think this is not a difficult one. You can do it very easily. Just try and just give the answer, because it is very much good for you to do the things as and when we discuss the things. The participation is very important, active participation. And you can ask questions, you can give some logical arguments, whatever it is. First you calculate the return. because here 125% of weight contributed by the risky asset. If you get an answer for this correct answer, so that means now you just understood this. And it is very important point. It is not a just a routine type of a thing, small thing to be looked into here. Some peculiar thing come in here. Try your best to do it. Now, this is a simple thing because 125 means 125% means 1.25 as a weight. Then what is the weight of risk-free asset then? It should become minus because it's a borrowing. The numbers are clear, no? Risk-free assets given a return of 9%, risky assets given a return of 20%. Now, by doing this type of investment, the investors expect to have a higher return. That is why they do it. That is why they have a leverage portfolio like this. Try to get the answer. Anyway, I can give you a break now, and by 10:45 I will start. Ms. Ansala, you are return. There's a small issue, I think. I really appreciate now her attempt, and anyway, just try and see. It looks like something wrong. And Mihirani has raised hand, and yes, Mihirani, what is the problem? Now, I will just explain the way it has to be done. Sansala, you can just look at it. Now, 125% is the weight of risky assets, and its return is 20%. So then what happens is you have to have 1.25 as the weight, and it is multiplied with 20%, that is 0.2. 1.25 into 2 or 1.25 into 20, whatever it is. So you can have 1.25 into 20. Then the other one will become minus, because the risk-free asset weight would be minus 0.25. Minus 0.25 or minus 25%. Minus 0.25 we need to take. So minus, minus 0.25 into 0.09. So then 0.09, no, we can say 9. 9 into 0.25, it has to be deducted. So that is how we do the things. Anyway, I will do it on the board. Now just look at it. The return is equal to risky assets weight is 125%, that is 1.25. 1.25 into its return is 20%, so we can say 20. Then plus, what is the weight of risk-free assets? That is 0.25 is minus. Then only you get 1.25 minus 0.25 comes to 1. That is why we take it as minus 0.25 into, now 9% is the risk-free assets return. So we have to multiply it with 9%. 9. Now we will do this. This will come as 20 into 1.25. It comes as 25. Then this will become minus, because minus 0.25 into 9 is minus something. So that is the value comes here. 0.25 into 9. That is 2.25, it's minus. Now I think people have made mistakes here. The weight here is a minus value. Minus 0.25 into 9. That comes as minus 2.25. So 25 minus 2.25 comes as 22.75. Is the answer. Is the return. Is that okay? Because I request all of you to participate with the activities, then only you can learn the things. Otherwise, it's very difficult for you to learn, right? But even what we need to do is next thing, that is, I think Nisansala made a mistake at getting 30%. Maybe you have taken it as 30% or whatever. That's what I think. Yes, minus 25. Yes, that's what. Actually, I was really explaining these things several times. It's like this. Now, when we say there are only two types of portfolios. One portfolio is a risk-free portfolio. The other one is a risky portfolio. Now, when one invested 125% in risky assets, now, in order to have both 100%, you need to have minus 25 from the other asset. That is how it comes. Other asset in the sense are the risk-free asset. So minus 25 plus 125 125 comes as 100. That is how minus 25 came. And the meaning of that is we have not invested there, we have borrowed. The investor has borrowed. So that is how it came. So with that, you got that answer 22.75. That is the return. And in the same manner, you can do the risk also. So there's a formula for that. Sigma P P is equal to sigma M XM. Sigma M XM. That is how you can do it. So therefore, I will do it on the board also. Now we had a in the lesson I have explained that. Now you just look at this theory part. Here, sigma B is equal to XM sigma M. XM is the weight of the risky assets. Sigma M is the standard deviation of risky assets. So with that, we can solve this equation. Now I will do the risk part also. Sigma P is equal to XM sigma M. XM sigma M means XM means the weight of the risky asset. The weight of the risky asset is 1.25 or 125 into what is sigma M? Sigma M is 30%. 30%. Now what is the answer for this? 30 into 1.25. 30 into 1.25. 37.5. So this is the answer for standard deviation. Sigma. Yes, Ms. Ansala, now I think you understood that. Right. Now, Nisansala has got the answer for standard deviation. I think now you realize what to do. Anyway, others also should engage in these things, and I like to have your own comments and all that. Anyway, we will again go to the question, or again go to the lesson. I think I just advise you to do all these questions, and if you had if you come across any type of confusion or clarification, you need to just ask me. So that is what you need to do. But the last question also we need to try. That is why I just come to that again. Now, the question number 4. I don't know whether anyone has attempted this question or whatever. Anyone has attempted this question? Right. Anyway, now I will just explain that, because this is very important one, because sometimes in your examinations also there can be 3 assets portfolio where you need to calculate. But it is very rare if you get a question to calculate a portfolio risk of a 5 asset or 10 asset portfolio. That's very rarely come. But anyway, even if you have that type of portfolio, you should be in a position to calculate the risk. Right. Anyway, determine the risk and return for an equilibrated portfolio of assets X, Y, and Z with the following inputs. Now, the X, Y, and Z, their returns, expected returns are given. Expected return of X is 15%. Expected return of Y is 17%. Expected return of Z is 20%. And their standard deviations are also given, that is sigma X is equal to 18%, sigma Y is equal to 20%, and sigma Z is equal to 25%. And at the same time, the correlation coefficients are also given. The correlation coefficient between the returns of X and Y is 0.5. Between Y and Z is 0.2. Between X and Z is minus 0.5. Now, those are given. Now, first of all, we need to calculate the return, portfolio return, including the assets X, Y, and Z with equal weights. What do you mean by equal weights? 1/3 of each. So X you have 1/3, Y you have 1/3, Z also you have 1/3. So how are we going to put it? So just do the calculation and arrive at portfolio return. Just arrive at portfolio, because this I expect you to do it at home, but you have not done it yet. Anyway, you now do it. Now you can get the portfolio return. That is very easy. Yeah, it's very easy. I think since it is weighted equally, it's easy to calculate. Yes. Yes, there's a request to explain the question number 1 in the board. Anyway, I will see whether I can have time for that. Anyway, now you do this question. I mean, this return. Because if you can follow it when I do the things, I don't think that you need again those things. But anyway. Yes, let me have your answer for this. This is very easy, the first part of it, because you need the return only. 17.39. Can you try it again? Others also can try. Now you have the returns 15%, 17%, 20%. Wait. 15 point 17 is 32. 52. Udeshan, yes, you are correct. 17 point, yes, 33, yes. Sanjeeva, yes, correct. Indika, correct. Okay, now you have done it. Good attempt. And all others should engage. Without engagements, you may not be in a position to graph these things, because just listening will not help. Because the listening, actually, you might realize that you understand these things, but you may not. At a later stage, when someone asks you something, then you might think that you have not heard about these things even. So that is the issue. So therefore, you try your best to engage, basically. Now, the second part. We'll go to the second part now. Right. Now we had a connection issue. Now I will try to explain the question number 4 on the board. Now you just look at the data. Expected return of X is 15%. Expected return of Y is 17%, and expected return of Z is 20%. And all are equally weighted. So that means each one has a 0.33 weight. 0.33 weight. So, yes. What is the issue? I can't hear you. Hello? Yes, any issue? Right. Now then the standard deviations are also given. 18% X is 18%, that is standard deviation of X. Standard deviation of Y is 20%. Standard deviation of Z is 25%. And the correlation coefficients are given. Correlation coefficient between X and Y 0.5, Y and Z 0.2, X and Z minus 0.5. Right. The weights, of course, WX, WY, and WZ equals to 0.33. So what we can do is we can now write the formula for the portfolio risk. Sigma p squared is equal to sigma x squared wx squared plus sigma y squared wy squared plus sigma z squared wz squared plus, now we start with xy, 2 wx wy sigma x sigma y rho xy plus 2 wy wz rho sigma y sigma z rho yz plus 2 wx wz rho xz, sorry, sigma x sigma z rho xz. So this is the formula. I will go through again. Sigma p squared, that is the portfolio risk squared or standard deviation squared or variance, will equal to sigma x squared wx squared plus sigma y squared wy squared sigma z squared wz squared 2 wx wy sigma x sigma y rho xy plus 2 wy wz sigma y sigma z rho yz plus 2 wx wz sigma x sigma z rho xz. Now what we need to do is we need to substitute the values for each of these things. Sigma x is given as 18%, so we can say 18 squared, and here you can say 0.33 squared, 20 squared, 0.33 squared. Sigma z is 25, so 25 squared, again 25 squared, yes, 0.33 squared, plus 2 into 0.33 into 0.33 sigma x sigma y. Sigma x is 18, sigma y is 20, rho xy is 0.5 plus 2 into 0.33 into 0.33 into sigma y sigma z, 20 into 25 plus, sorry, rho yz is 0.2 plus 2 0.33 into 0.33 into sigma x sigma z, that is 18 into 25. Then again it has to be multiplied with minus 0.5. Minus 0.5. Right, now this is the way of calculation. Now you try to do the calculation and come up with the answer. Do the calculation and come up with the answer. Yes, have you got it? Now you try to get the answer. Now I have just put on the board the way you can do the calculations. Here the calculations are given here. Now, first of all, you look at this sigma b squared is equal to wx squared sigma x squared plus wy squared sigma y squared plus wz squared sigma z squared. No, these are the three quadratic type of terms. Then you get 2 wx wy sigma x sigma y into rho xy. So that is the first term, that type of a term. Then next again you get 2 wx wy wz sigma z sigma y rho yz. Then you get 2 wz wx sigma x sigma z and rho xz. So that is how the formula comes. Now we need to then substitute with all the values. So after value substitution, you need to get an answer. Only thing is, now the last term will become minus because rho xz is minus. That is minus 0.5. Rho xz is minus. It is minus. So because it is minus, so you have to add up here. Yeah, good, very good. Murthy, your answer is correct. And you have to get the square root in order to have the standard deviation. Murthy, you are very good. I mean, you got the answer correct. Yes, 12.6 is the standard deviation. Yes. All others should attempt. Because, you know, if you do these things and get it familiarized, you will get a great advantage. Because in your decision making process, or if you are in a forum or in a meeting and you put forward something, some ideas, you will be in a position to very clearly get through your idea, the thinking pattern or whatever. So therefore you need to participate in this type of things, then you can activate your mind basically. Okay. Right. So with that, I want to tell you, yes, Damin, correct. 12.6, yes. All others should attempt and send me the answers. Right. Of course, now you might wonder, now when many assets being taken into a portfolio, what should be the way of getting into this particular formula? So there's a particular way of doing it. And say, if you have 4 assets, what will happen? So there's a particular chart or whatever you can make use of to have it. And we call it the variance covariance matrix. So when you have 4 assets, I will show you how to derive that variance covariance matrix. I will just explain the situation where you have 4 assets in the portfolio. this way. Sigma 1, 1, sigma 1, 2, sigma 1, 3, sigma 1, 4. Then sigma 2, 1, sigma 2, 2, sigma 2, 3, sigma 2, 4. Sigma 3, 1, sigma 3, 2, sigma 3, 3, sigma 3, 4. Sigma 4, 1, sigma 4, 2, sigma 4, 3, sigma 4, 4. Now, this is what you call variance covariance matrix, where in the diagonal, along the diagonal, you have all the variance figures. So then, if you take sigma 2, 1 and sigma 1, 2, it's the same. Right? So then, you are in a position to derive these equations. So the W's, if you take that way, W1 squared, sigma 1 squared, plus W2 squared, sigma 2 squared, W3 squared, sigma 3 squared, W4 squared, sigma 4 squared, plus, now then 2, W1, W2. Or sigma 1, 2. We can say this way. Now, sigma 1, 2 meaning covariance 1, 2. Covariance 1, 2. So, sigma 1, 2 means covariance 1, 2. Right? Or we can say covariance 1, 2. What is the next figure? 2W1, W3, covariance 1, 3. Plus 2 W1, W4, covariance 1, 4. Anything else? So now you can just take it this way. Now, this is the diagonal. All these things will come. 1, 2, 3, 4, 5, 6. These 6 terms will come in addition to the square terms. There will be 4 square terms. Another 6 terms which will come with the covariances. I don't know whether you got my point. So it is easy for us to do it by looking at this type of a variance covariance matrix. So this is a further thing, but I don't think that this will be a very necessary type of thing for you. But I just want to tell you the way forward. So from this particular variance covariance matrix, you will be in a position to extend it to any number of assets. Any number of assets. Right? Anyway. Then I will go into the next lesson. Yes. That of course we just touched up something. Yes. I think all of you now see the screen with the new lesson. Now here we are going to discuss about capital asset pricing model and security market dynamics. Diversifiable and undiversifiable risk of a security. That of course we discussed at the beginning today. Risk reduction through simple diversification. Importance of characteristic line. Alpha and beta coefficient of a security. Related market dynamics explained through CAPM and market equilibrium. Now these are the things which we are going to discuss over this lesson. The first part of it, I have already explained these things anyway with diagrams. At the beginning of today's sessions, I just went through these things: diversifiable and undiversifiable risk of a security. So I think you can imagine what we have done that time. An asset's total risk can be divided into systematic plus unsystematic risk, as shown below. Now here, the equation is given like this: systematic risk plus unsystematic risk is equal to total risk. And that is the variance or whatever. Another name given for unsystematic risk is idiosyncratic risk. Now, this idiosyncratic risk can be reduced through diversification, simple diversification. Now, diversification is adding different types of assets into the portfolio. So, at the beginning, when you add one by one to the portfolio, your total risk will become lower and lower. But when you add in up assets further, there's a particular stage where even though you add assets, there won't be any reduction in the total risk. So that point you have to note. From that point onwards, you will not get any reduction of your total risk when you add even other assets. From that point, if we can just calculate the level of risk at that point. So that is the risk where you cannot reduce by diversification, which is called systematic risk or non-diversifiable risk or undiversifiable risk. Now you see the graph here. I have shown you a different graph earlier, and you can just look at this unsystematic and systematic risk here. So number of randomly selected securities in the portfolio. Now here, about say 24. From 24 onwards, even though you add assets to the portfolio, your risk will not come down. It goes on the same levels. So that particular level is called the systematic risk. So there you have to have, if you can just put a arrow line here, so that is the amount of risk, systematic risk. I think you get an understanding here. And other thing here is, now when you diversify, the effective risk reduction comes with the assets with opposite type of correlations or negative and positive correlations together. Now, if a positive correlation is with some asset, if you can add another asset with a negative correlation, then there will be a very good risk reduction, and very effective risk reduction will come with that particular situation. Now, if you add an asset where when you add it to the particular asset group, then you will have correlations or correlation coefficient which is minus. So then we go into another thing called characteristic line. Now it is a financial model. Now actually in our investment analysis or portfolio management type of things, we need to go for different types of models. Now what is a model? Model is a particular way of solving something, and it's a type of a structure where you need to learn, or it's a type of a measuring device or it's a type of representation of something. It's like, modeling. So the model doesn't mean it is the actual one, but it is a type of representation of actual one. That is what it means. So the models can be represented, or even the representation of a model is very much close to a actual position, but it may not be the actual position. So therefore, the models sometimes can really crop up issues. In this particular financial model, there's a thing called characteristic line. It is used to measure both systematic and unsystematic risk. The equation for the characteristic line, or we call it sometimes the regression line. So where you get the value for RIT. So RIT is the return. RIT is the return of an asset at time t. So AI is the intercept for the ith asset. I will show you what you mean by intercept. And VI is the slope V for the ith asset, a measure of systematic risk. And RMT is the market return. RMT is the market return. EIT is the random error around the regression line for security I during the period T. Now here you can see, if you take the equation into consideration, now this equation shows two variables. One is RIT, or the return of the particular security at time T, and the other variable is the market return at time T. Now these two variables are related. So RIT is known as the dependent variable, and RMT is referred to as the independent variable. The equation C shows the relationship of one security with the market and is sometimes called market model for one security. This is only for one security and in a particular time. These equations regressions are formulated so that the error terms will average out to 0. As a result, the characteristic line is normally written without T subscript as this. Ri is equal to AI plus Bi Rm. Now you can just compare these two equations. You can see that T is not there. At time T is not there. And EIT is also not seen in this particular equation. So how do we get this? And what they did was they just have a equation with different iterations, and with all these iterations, this E or the error part has been taken out. It has been averaged out to 0. That's what it means. So then the equation will become Ri is equal to AI plus Bi Rm. Now I will put it on the board, right? So what is Ri? Ri is the return of that security. Rm is the return of the market. So what do you mean by the return of the market? So this return of the market is, in a stock market, there are different indices. Now in Sri Lanka, we have our Colombo Stock Exchange. We have all share price index. That is what you call a market index. And we have another one called S&P 20. That is also in relation to the Colombo Stock Exchange. There you have taken only 20 firms which have been quoted in the Colombo Stock Exchange, but that 20 been selected especially the blue chip type of companies, and that 20 will create another index. That's what we call S&P 20. Now, those indices represent the market. Therefore, the market return means the return represented by those indices. Now, I don't know whether you got any idea when I say that returns are really represented through the market indices. Now, I will give an example. Like now, market indices, I think you all have heard about this all share price index. Nowadays, actually, there was a news item that said, I can remember, if I remember correct, last week on a day, on Monday or Tuesday or somewhere, the particular the index went up to 10,000 points. About 2 years back or 1 year back, the index was around 6,000 something. Now for 1 year or so, it has gone up to 10,000. So that's a big achievement, I think. So that is what you mean by market index. Now I just will take that market index as the representation of the Colombo stock market, Colombo Stock Exchange. And I will give you 2 days on which the index was taken, right? So I will just refer to 2 days. The first day I will select from the 1st of January thing, and then the 30th of June thing. So then we will be in a position to calculate the market return. So I will put it as an example, right? Anyway, so we will do that. Now I will put something on the board. On 1/1/2020, the ASPI was 6,000. The index was 6,000. On 36/2020, it went up to 7,500. According to this data, estimate the market return of Colombo Stock Exchange. Yes, do it. Now you should be in a position to visualize what you should do on the basis of this data. It's rather easy. I think we did some examples for something else at the beginning of our sessions. Just do it. Just calculate the market return. So easy. So that is what you mean by the market return, right? Now there are several markets in the world. IMEX, there's a Mumbai Stock Exchange and all sort of stock exchanges. You get the related market indices. IMEX is one of that type, market index. Yes, you try to calculate it. Try to calculate the market return here with the data given. So it's so easy. I don't know why you are not attempting. Yes, very good. Udeshan has done the thing and he got the correct answer. Others also should try. Now I am referring to the market index. I am not referring to any stock or whatever. If I refer to a stock, then it would have been the return of the stock, not the market. Now here we have taken the index as the representative of the market, and then we do the calculations accordingly, and with that we can arrive at the market return. Yes, others also should try and get it. Yes, Chamali, correct. 25%. Right. What did you do? So what you have to do is on 1st of January, the market index was at 6,000. Whereas on 30th of June, it came up to 7,500. So you can see the increase. The increase is 1,500. So that increase we need to estimate on initial index. The initial index was 6,000. So 1,500 divided by 6,000, the answer, and that comes to 25%. But only thing is now this return, this market return is not annualized. It is not annualized. So we have only taken the return for the half year. How can you annualize that? Try to annualize it and give the answer. Because that also we did once. Yes. After annualizing, can you give the return, stock return? Annualizing with the annualization or the formula or effective rate formula. You have to apply that. Then you can come up with the annualized rate. Yes, Chamali, you can try that. Deshan, you also can try. Can you remember we did it once? 1 plus r to the power 2 minus 1. So you will get the effective annual rate. Very good, very good. Chamali has done it. 56.25. Yes. So what to be, you have done this way, no? 1.25. 1 plus 0.25 is 1.25. So you should get 1.25 squared. That comes to 1.5625. Then minus 1 will come to 0.5625. 0.5625 is equal to 56.25%. Right, good. Anyway, so Udeshan also done it. Right. Now we will go to the lesson again. Right. Now, of course, now they talk about this market return. Now this market return can vary day by day, right? It might vary. So since it varies, we can take it as a variable. In the same manner, individual stocks also can vary the returns. So that is also a variable. So the return of the stock is also one variable, and at the same time, return of the market also a variable. So these two are variables. Now, what we want to signify here is the market return will have an effect on the stock return. So therefore, we have taken market return and the stock return as two variables. So market return has been taken as the independent variable, and stock return has been taken as the dependent variable. Now you have to take a similar situation in another form. That is, have you heard about this equation y equals mx plus c or whatever? Now here the things been little changed, but the order has been changed. But anyway, the same thing is discussed here. If you take this equation, Ri is equal to Ai plus Bi Rm. So this Rm is the independent variable. Ri is the dependent variable, and Bi is the slope, or we call it the beta coefficient. Ai is the alpha coefficient. So that is how the security is really explained through the characteristic line. So the beta coefficient of B can be calculated by dividing covariance of stock and the market divided by variance of the market return. So we call the covariance with the same one asset and the market as units of rise, and variation of the market or variance of the market return as units of run. So we call it the slope of the regression line. Okay, now these things are little confusing at the beginning, but you will find that those things are not that confusing if you get familiarized with these things. So in order to get familiarized, you have to have some practical examples. So then it is easy for you to understand. Again, I will go to the equation. Now we have started with the equation, this equation, and we call it the characteristic line, basically. So that line refers to the market return as well the stock return, and there's an error term also. So with that error term, if you do these things repeatedly, then this EIT can be taken out. That's what it says, the tandem error around the regression line for security I during the period T. And The equation C shows the relationship of one security with the market and is sometimes called a market model for one security. These equations regression are formulated so that the error terms will average out to 0. As a result, the characteristic line is normally written without T subscript as Ri is equal to Ai plus Bi Rm. Here, Ai is called the alpha, Bi is called the beta. Now you need to consider that we are talking about a stock market asset or stock where it has a return of I. When the market return is Rm and Bi is the beta, Ai is the alpha. And again, there's another definition for beta that comes with beta is equal to covariance, the asset, and the covariance between the asset return and the market return divided by variance of the market return. We can just do something with correlation coefficient and standard deviations to give another form of this equation or another form of this relationship. I will do it on the board. Right? I will do it on the board. Now our characteristic line is Ri is equal to Ai plus Bi Rm. Here Ri is the asset return or stock return. Right. Now this is the characteristic line. Why do we say characteristic? Because it characterizes the stock return. The stock return is given by Ri and Rm is the market return. Now in the particular equation, these two are regarded as variables. Now Rm is the independent variable. Rm is the independent variable. Ri is the dependent variable. The meaning is when you have a change in the market return, there will be a corresponding change in the stock return. That is what it means. So that is why people are looking at the market whenever they try to invest in the stock market, because they know that when the market behaves in a certain manner, the stocks the person holds will have relevant effects coming through the market. So that is how the characteristic line is given. So that signifies the relationship, because when there's a change in the market return, invariably the return of the stocks an investor holds will have an effect. It can be a favorable effect or an unfavorable effect, because people are very much afraid of unfavorable effects. They are always very much vigilant on the market behavior. Right? So this particular equation is called the characteristic line. Why do we say characteristic line? Because if you plot it between Ri and Rm, you will get a straight line. You will get a straight line. So that straight line, since it is a straight line, we call it characteristic line. So because this Rm can be taken as x, or the x variable that really we signify, so we taken along the x-axis or horizontal axis. This is taken as y, and it is taken through the vertical axis. So if I can signify it this way, Ri Rm. Right. When you draw a line like this becomes the characteristic line. This becomes the characteristic line. And this particular distance we call AI. Right? So the BI is the tangent. This is what you call BI. Right? Anyway, now this is a type of representation only. So you can get an idea from this, and I will go to the next line. Right, after getting this example, we have to now try to see what are these alpha and beta. So AI is the alpha and BI is the beta. So in other words, if you look at the graph, here you can see this graph. I have taken the Ri into the y-axis or vertical axis and Rm into the horizontal axis. With that, if I draw a graph, the graph comes like this, and that is a straight line. And this particular amount, we call it the intercept. That is alpha. That is what you call alpha, and we signify it by AI. And there's a particular angle here. The tangent of that angle is called beta or BI. Right. Then we can explain BI with another form. That is what here they have done. We have done it here. Covariance RIRM divided by variance RM is the beta. Because when you talk in terms of beta, that is, we need to check the covariance between the stock and the market, stock return and the market return. And we will compare it with the variance of the market return. Variance of the market return. So in other words, the beta means in relation to the market return, how the stock returns behave. In relation to the market return. In relation to the market return, how the stock return varies with market return. So that is what it means. Right, these substitutions being made because covariance Ri and Rm can be given as rho Im into sigma I sigma m, and it has to be divided by sigma m square. So then sigma m and sigma m cancelled off, then you will get rho Im into sigma I divided by sigma m. So this is beta. Therefore, after cancelling off the sigma m terms in both the numerator and denominator, Bi can be given as rho Im into sigma I divided by sigma m. Now, this beta coefficient, now we talked about systematic risk. So, beta coefficient is an index of systematic risk. Betas can be used for an ordinal ranking of the systematic risk of assets, but not for a direct comparison. Because when betas can be calculated, so those betas can be used for an ranking of systematic risk of assets. So for example, say if you have 3 assets and you have betas, the highest beta will signify the highest systematic risk. Highest systematic risk. Now, these betas can be taken as indicators of systematic risk. If an asset is found with betas higher than 1, we call such asset an aggressive asset because it is more volatile than the market portfolio. So what we do is we do a comparison with the market. Together with beta, we can do that. Beta, if you get a beta which is higher than 1, the meaning is the asset is aggressive because if you compare it with the market volatility, it is more volatile than the market. So that is what you mean. For example, if an asset has a beta of 2 and the market goes up by 10%, this asset will increase in return by 20% on average. That is what it means. And when beta is less than 1, we call it a defensive asset. If an asset is having a beta which is less than 1, such assets are called defensive assets. And there's another mechanism we can found here. The correlation coefficient rho projects a mechanism to find out the portion of systematic risk in the total risk of a security. Now, it is a good way, or it is a good method in order to have an idea. If you take the risk of a particular asset or whatever, what is the portion of systematic risk in that? So such knowledge is very much important for our analysis purposes. In that relationship, rho squared is the portion of systematic risk in the total risk of the security. Now, if the total risk, now normally the total risk is denoted by sigma squared or sigma I squared, whereas portion of systematic risk is given as rho squared. Now there will be a proof for this, but I am not going to explain on that at this point because it might put you into a greater confusion. So therefore what I want to do is I want to just apply these concepts and work out some problems. Therefore, we can get the unsystematic portion of risk by deducting the systematic portion from 1. So for example, if you get rho squared as 0.64, then what is the systematic portion? 0.64 or 64%. Then what is the unsystematic portion? 36%. So that is how the things been calculated. Now you can just see the rho. If rho is lower than 0.5%, that means rho squared would be lower than, say, now if you can have an example, right? Rho is 0.25. Rho is 0.25. What happens? What would be rho squared? Yes. When rho is 0.25, what is the rho squared? .0625. Rho squared would be 0.0625. So that is 6.25. Now you can see when the rho is not close to 0, not close to 1, the systematic portion is lower in the total risk. So that I think you can understand. Anyway, now we will see how we can arrive at a certain thing. Now here I have given that example. rho is equal to 0.8 and rho squared is equal to 0.64. Therefore, the unsystematic portion is 36%. Systematic portion is 64%. Right. Now I will ask another question here. Now company 2. Right. Let us have the company 2's. Now I am asking from you. You have to arrive at the company 2. The company 2's systematic portion of risk and unsystematic portion of risk. Just calculate. It is given here, but anyway, you do the calculation and see what it is. Now, with this data only, you need to calculate that. So tell me the systematic portion of company 2's risk. Systematic portion, right? Yes. Do it quickly. Do it quickly, and now we are coming close to the end of the session. Anyway, yes, do it and see, because you all have to work out examples to get the better learning. Yes. Now, what is the systematic portion of risk of the company 2? Yes, Rammelini. Yes, 0.5625 actually. So what you need to do is you need to get 0.75 and it is to be squared. Then you get 0.5625. Indika's answer is correct. And even Rammelini, I think you have omitted that 25. I think you wanted to put it in 2 decimals. Is that the case? Anyway, it's okay. Right. Now you can say, what is the unsystematic portion? What is the unsystematic portion of company 2? Yes. 43.4375 or 43.75. That's correct. Yes, correct. Right. Now I think you got the point. And if I go again to the example, there you can get the following are the characteristic lines representing 3 company stocks. Now each company stock representing 1 characteristic line. Now for company 1, you have R1 is equal to minus 0.5 into plus 1.25 Rn. Now I am just asking a small question here. What is the beta of company 2? What is the beta of company 2? What is the beta of company 2? Yes. What is the beta of company 2? Through the characteristic line, you can get it. The beta. Yes. What is the beta of company 2? I think it is in the papers also, but I don't know. Yes. Yes, let me have the beta of company 2. So simple. Just have the company 2's beta. You go through the line and see what it is. because you need to get the coefficient, beta coefficient. Now you can just look at company 2, R1 equal 1.25% plus 0.95 RM. So where are the beta? Where can we find beta? Very simple. And if you even if you go to company A also, you can find beta somewhere. It's very easy. Now you just compare this equation with that. So this is the equation to be compared here. So beta comes here, no? Yes. So what is the beta of company 2? Just just give an answer. Even though it's correct or wrong, you can give it. Just to say what is beta for company 2. Company 2 is given in the on the note. Yes. Quickly give. Now just look at the equation R1 or Ri equals AI plus Bi Rm. Now in the place of Bi, what is here? In the place of Bi, what is here? So that is what you call beta. In the place of Bi? Yes, of course, 0.95. Ms. Ansala, correct. 0.9. Rammelin is correct, yes, 95. So in the same manner, you can get the betas of other companies also. Not only company 2, company 1, company 3. All betas you can get from the equation. Because that is the beta coefficient. So that coefficient is 0.95 for company 2. Right, I think you all can do the other things also. Now we have come to the end part of the session. And I must tell you that you, to get the best out of these sessions, you have to participate actively in the sessions. I think most of you now participate. If I guess it correct, anyway, I like to ask others also to participate actively in the sessions. Otherwise, you would not be in a position to grasp the best out of these sessions. And at the same time, you need to clarify whatever you need. I mean, if you get any confusion, any type of a clarification, you must ask. You must, then and there you should need to ask the questions. Then I will be in a position to clarify the things, and then it would be beneficial to the others also. Therefore, you do it every time. Always you do it. Anything you need to clarify on today's lessons? Yes. Anything to be clarified? Because in my opinion, we had certain type of challenging type of concepts we discussed today. With that discussion, you might have some type of confusions or other. So therefore, you need to see what are the types of confusions you have. Yes, Murthy? Yes. Anything we need to clarify?
No, sir. Nothing.
Right. And I just I want to tell you again, I'm emphasizing this because you all should get the best out of it. Then only you can be successful. And this is not only for the examination. So as a banker, as a financial division person, so you need to get this knowledge into your mindset, and you can make use of the knowledge in your day-to-day activities. That is what we expect from you by following this type of courses. And that will add value to you and your institution both. Right. Anyway, anything which you want to clarify? Video means what? No, actually the things we can just upload the notes, not the video, because video is recorded then and there. No? So okay. I mean, these notes are normally given, but there's no big necessity for that. But anyway, you need to follow up the notes which we have already given. Say, for example, now I have given the lesson number 1 note at the first class, and yes. Yes, of course. But I think it's like this. Now, I accept that. We will send it. No issue. We will send it. But what I want to tell you is, now, when you get the notes, the lecture video. The lecture video means now it is being recorded. No, when I do the lecture, so then you get the earlier sessions video before the next class. Okay. I will ask that. That's okay. Right, the new tutorials you will get, no issue. But here,
So excuse me, but it is uploaded. Excuse me, sir.
Yeah,
it is normally uploaded on Friday or Saturday. It is difficult to go through with that. If we can take it on at least Wednesday, then we can.
no, okay. No, we will do it. Right. That's okay. We will do it. But what I suggest is, now that is okay. That I accept. I will send it on at least on Wednesday. Yes, that is correct. But what I want to tell you is, now when we do a lesson, you have all the notes, no? So I mean, now say, for example, I have the lesson 1 given and lesson 2 also given. So before coming to the next one, the first thing what you need to do is, you need to follow up all those things. Otherwise, you would be find it difficult. So that's what I'm telling. Anyway, so that's the thing. But what you can do is, you can just follow the notes of earlier classes before coming to the class. But I accept that. I agree with you. I will send the things on Wednesday, at least on Wednesday. Right? That is okay. That is okay. So, but what I want to
Actually,
emphasize
sir,
is,
not only the
even
not
though
only
with
the
all
notes,
those
sir.
things, yeah. Yes. Then what?
Yes, sir. No, not only the
You need the videos also.
tunes, but also video also, sir.
Yeah.
We need.
Yeah, video actually now I will. Yeah. That of course I can ask the institution. So
Yeah.
they might send. They might put.
Recorded
Yeah.
class
That's okay.
lectures.
Yeah.
Previous
That
week
can be.
recording.
I will ask, but I don't know what is the normal procedure they do. But anyway, yeah. Of course, I will let them know.
Kindly inform to the institute, because as a practice they don't do that.
Okay. Right. With that, I think we can wind up the sessions today, and make sure that, with all that, if you don't participate actively, I don't think that you can get the best results out of it, right? Anyway, with all that, say thank you very much for your active participation and your questions and queries. Then we will meet again on next Sunday. Thank you very much.